Over the past several months, something subtle but important has been happening inside the global banking system. It has not looked like a dramatic collapse. There are no long lines outside branches. ATMs are still working. Markets open each morning. But beneath that surface stability, pressure has been building. Major banks across the United States and Europe are reporting rising funding costs. Liquidity facilities that were supposed to be temporary are quietly being used again. Bond portfolios, purchased during years of near-zero interest rates, are still sitting on unrealized losses. These losses do not always appear on headline earnings reports, but they exist on balance sheets. And balance sheets tell the real story. When interest rates were low, banks bought long-term government bonds. Those bonds were considered safe. But when rates rose sharply, the market value of those bonds fell. That created a gap between what banks paid and what those bonds are now worth. If held to maturity, the losses may never be realized. But if deposits leave and assets must be sold, the losses become real very quickly. At the same time, deposit behavior is changing. For years, banks paid almost nothing on savings accounts. Customers accepted it because alternatives also paid very little. That world is gone. Money market funds and short-term treasury bills now offer higher yields. Depositors are paying attention. Funds are moving faster than they used to, often with a few taps on a phone. This shift forces banks into competition. To keep deposits, they must raise rates. But raising deposit rates compresses profit margins. The traditional banking model, borrow short, LEND, long becomes harder to sustain when short-term funding costs rise faster than long-term loan yields. The result is tightening credit standards. Loan officers across multiple regions report stricter lending requirements. Businesses face tougher approval processes. Real estate financing is more selective. Credit lines are being reassessed. None of this is dramatic on its own, but together, it signals a change in behavior. And that is the key point. Banks are institutions built on confidence. They are designed to operate smoothly when trust is stable. When banks begin to conserve liquidity, rely more heavily on central bank facilities, and slow lending, they are responding to risk that is not yet visible to the public. Their behavior changes before the headlines do. This is where the deeper question begins to form. What are they seeing that we aren't? Markets offer clues. During periods when banking stress increases, certain assets begin to move in ways that do not align with short-term news cycles. Gold rises even when inflation data appears calm. Silver strengthens despite industrial uncertainty. These moves are often dismissed as speculation, but historically, precious metals respond less to headlines and more to shifts in systemic confidence. Gold does not rely on a counterparty. It is not someone else's liability. Silver carries both industrial and monetary role. When trust in financial intermediaries weakens even slightly, capital looks for assets that sit outside the credit system. This does not mean a collapse is imminent. It means behavior is shifting. And when behavior shifts at the core of the financial system, the effects do not stay contained. Banks sit at the center of money creation. They finance businesses, homes, inventories, and expansion. If they become cautious, credit slows. When credit slows, growth slows. When growth slows, pressure builds elsewhere. Banking stress is rarely isolated. It moves quietly through lending standards, investment decisions, hiring plans, and consumer confidence. It reaches households, not through dramatic announcements, but through subtle changes in access and cost. The system today is not breaking in a visible way. It is tightening, adjusting, bracing. And when the institutions responsible for liquidity begin to guard it more carefully, history suggests we should pay attention not to the noise, but to the signals. Because if banks are altering their behavior, it means the rules they operate under may also be starting to change. If banks are altering their behavior, it means the rules they operate under may also be starting to change. For decades, the basic banking model was simple. Banks borrow short-term money from depositors and lend that money out for longer periods at higher rates. The difference between what they pay and what they earn becomes their profit margin. When interest rates are stable and deposits are predictable, this system works smoothly. It is not flashy, but it is reliable. What changed was the speed and scale of interest rate increases. After years of near-zero rates, central banks moved aggressively to fight inflation. In a short period, borrowing costs rose to levels not seen in more than a decade. That shift exposed a structural weakness that had been building quietly during the Laurent era. Banks had loaded up on long-term government bonds and mortgage-backed securities when yields were extremely low. At the time, these assets seemed safe and sensible. Capital rules treated them as low risk. But when rates rose sharply, the market value of those bonds fell. The longer the maturity, the larger the decline. On paper, many banks labeled these assets as held to maturity, meaning they would not need to recognize losses unless forced to sell. But that assumption depends on stable deposits. And deposits are no longer stable in the way they once were. One of the first structural breaks is deposit flight toward higher yield alternatives. In the digital age, money moves quickly. Savers now compare rates in real time. Money market funds, treasury bills, and online banks offer competitive yields. When depositors shift funds, banks lose their cheapest source of financing. To keep deposits, they must raise rates, which compresses margins. If they fail to compete, liquidity shrinks. The second break is the quiet expansion of central bank backstop facilities. During times of stress, central banks provide emergency lending windows to ensure liquidity remains available. Recently, usage of these facilities has increased in subtle but important ways. The amounts may not always dominate headlines, but the pattern matters. When banks borrow more from central banks, it suggests private funding markets are less willing to extend credit on comfortable terms. The third pressure point is sovereign debt. Governments around the world carry historically high debt levels. During past crises, large fiscal stimulus packages supported the banking system. Today, that capacity is more constrained. Higher interest rates mean governments themselves face rising borrowing costs. Rescue capacity is not gone, but it is more limited and politically sensitive. Then there is regulation. After periods of stress, regulators often tighten oversight. Capital requirements adjust. Reporting standards evolve. Liquidity coverage ratios are reassessed. Recently, rule changes have moved faster than usual. That pace reflects concern. When regulators accelerate adjustments, it signals that risks are being reevaluated in real time. Taken together, these breaks represent a shift away from the stability of the previous decade. The old environment, cheap money, steady deposits, expanding credit allowed banks to operate with confidence. The new environment demands caution. Historically, when banking systems rely more heavily on central bank liquidity, it signals fragility rather than strength. This does not mean collapse is certain. It means the private system is leaning on public support more than it would prefer. Confidence becomes the main pillar holding the structure upright. And confidence is different from capital. Capital is measurable. Confidence is psychological. Once trust begins to thin, even slightly, behavior changes quickly. This is the big signal. The system is increasingly dependent on belief rather than buffer. Markets sense this before official statements acknowledge it. That is often why gold begins to rise, even when inflation appears contained. It is not reacting to a single data point. It is reacting to the broader shift in financial plumbing. Silver follows in a more volatile way. It sits between industry and money. When credit tightens, industrial demand may slow. But when trust weakens, monetary demand rises. Its price behavior reflects this tension. These moves are not random. They are responses to a system that is adjusting under stress. And when trust in financial intermediaries becomes the central variable, the story extends beyond bank balance sheets. It moves into global trade flows, resource control, and geopolitical leverage. Because once financial strength becomes uncertain, real-world assets begin to matter more than financial engineering. Because once financial strength becomes uncertain, real-world assets begin to matter more than financial engineering. This is where the focus shifts from bank balance sheets to something more tangible: supply chains, commodities, and control. The real battle is not only about interest rates or liquidity windows. It is about who controls energy, metals, food, shipping routes, and the systems used to settle trade. For decades, globalization reduced the importance of geography. Goods moved efficiently across oceans. Just-in-time inventory kept costs low. Financial markets handled settlement, and the dollar sat at the center of that system. Stability in banking allowed the physical economy to operate smoothly. But geopolitical tensions have changed that equation. Sanctions have become a financial weapon. Trade restrictions have expanded. Strategic industries are being reshored or diversified. Countries are rethinking dependence on distant suppliers for critical materials such as rare earth elements, semiconductors, and energy inputs. Energy security, in particular, has become a national priority. When energy supply is disrupted, entire economies feel the impact. That reality has encouraged resource-rich nations to recognize their leverage. Commodity producers now understand that control over supply is power. When supply tightens, pricing power shifts toward those who extract and refine essential materials. Oil-producing countries coordinate output levels more carefully. Mining nations negotiate tougher terms. Agricultural exporters impose temporary bans to protect domestic stability. These are not isolated decisions. They reflect a broader awareness that real assets anchor economic resilience. At the same time, emerging markets are reassessing their reliance on the existing financial architecture. Groups such as BRICS are exploring alternatives to dollar-based settlement. Bilateral trade agreements increasingly use local currencies. Cross-border payment systems are being developed outside traditional Western frameworks. These experiments are still evolving, but their direction is clear. When trust in the global banking core shows signs of strain, nations diversify risk. Reducing exposure to a single currency or settlement channel becomes a strategic objective. This does not mean the dollar disappears. It means the system becomes more. Central banks are signaling this shift in a quieter but measurable way by increasing gold reserves. Over the past several years, official sector gold purchases have risen significantly. Central banks are not trend followers. They move slowly and deliberately. When they accumulate gold, it reflects a desire for neutral reserves as assets that do not depend on another country's promise to pay. Gold has no counterparty risk. It settles instantly and globally. In a world where sanctions can freeze foreign reserves, that characteristic becomes more valuable. Gold becomes less about inflation and more about sovereignty. Silver occupies a different but equally important space. Its demand is tied to industrial growth and the energy transition. Solar panels, electric vehicles, and advanced electronics all require significant silver inputs. As nations invest in renewable energy and electrification, silver demand gains structural support. This dual-identity monetary and industrial places silver at the intersection of economic growth and financial uncertainty. If industrial expansion accelerates, silver benefits from material demand. If financial stress rises, it benefits from monetary demand. That combination makes its price behavior sensitive to both global manufacturing cycles and shifts in systemic confidence. The key idea is that power is moving away from pure financial engineering and toward control of real assets. For years, derivatives, leverage, and credit expansion drove returns. Now, control over supply chains, energy corridors, and critical minerals is becoming central to national strategy. Headlines still focus on stock indices and central bank press conferences. But beneath that layer, nations are building stockpiles, renegotiating trade routes, and investing in domestic production. These decisions reflect a long-term repositioning. Gold and silver sit at the crossroads of this transition. They are not just commodities. They are bridges between money and materials. Their price movements often capture tensions that traditional financial metrics miss. When financial confidence weakens and geopolitical competition intensifies at the same time, precious metals begin to reflect both dynamics. They become strategic signals of global realignment rather than simple inflation hedges. And as this repositioning unfolds, the pressure does not remain confined to trade flows or central bank reserves. It flows directly into currencies, purchasing power, and the long-term value of money itself. And as this repositioning unfolds, The pressure does not remain confined to trade flows or central bank reserves. It flows directly into currencies, purchasing power, and the long-term value of money itself. The banking system sits at the center of money creation. Commercial banks extend loans, and in doing so, they create new deposits. Those deposits circulate through the economy as spending power. When banks are confident, credit expands. When banks are cautious, credit tightens. That shift influences not just markets, but the supply of money available to households and businesses. When stress enters the banking system, central banks face a difficult choice. They can maintain tight policy to control inflation, or they can ease conditions to prevent deeper financial strain. Each path carries if policymakers maintain high interest rates to keep inflation contained, weaker banks must operate under greater pressure. Borrowing costs remain elevated. Bond losses persist. Credit standards tighten further. Businesses face higher financing expenses. Consumers delay large purchases. The economy slows. In extreme cases, a credit contraction can amplify stress and push institutions closer to solvency concerns. On the other hand, if central banks choose to ease policy by lowering rates or expanding liquidity, they reduce immediate pressure on banks. Funding costs decline. Asset values stabilize. Confidence may improve, but easing too quickly risks weakening the currency. When rates fall relative to other countries, capital can move elsewhere in search of yield. A softer currency raises the cost of imports and may reignite inflationary pressures. This is the core dilemma. Fight inflation and risk financial fragility, or support banks and risk currency debasement. Government debt levels complicate this decision. Many advanced economies carry historically high debt-to-GDP ratios. Servicing that debt becomes more expensive when interest rates remain elevated. Fiscal flexibility narrows. Large stimulus packages become politically and financially harder to justify. In past cycles, governments could respond aggressively to downturns. Today, the margin for error is thinner. Currency volatility then becomes a second-order effect. Exchange rates influence the price of energy, food, and manufactured goods. A weaker currency can raise the domestic cost of imports. That cost filters through supply chains, affecting everything from fuel prices to grocery bills. Even small shifts can accumulate over time, reducing purchasing power. Gold historically responds to these dynamics in a measurable way. It tends to perform best when real interest rates, nominal rates, minus inflation decline. When the return on cash and bonds fails to keep pace with inflation, the opportunity cost of holding gold decreases. At the same time, gold often strengthens when confidence in currency stability weakens. It acts as a hedge against policy uncertainty and monetary dilution. Silver behaves differently, but is influenced by similar forces. Its volatility reflects its dual identity. When industrial demand is strong, silver benefits from manufacturing growth and energy investment. When monetary stress rises, it benefits from safe haven flows. That combination makes silver more reactive to swings in both economic optimism and financial fear. The important point is that these macro forces do not stay in abstract policy discussions. They translate into everyday outcomes. If credit tightens, small businesses struggle to expand. Hiring slows. Mortgage rates remain elevated. Home affordability declines. If currencies weaken, imported goods become more expensive. Savings lose purchasing power gradually, often without dramatic headlines. Over time, households feel these shifts through subtle changes. Credit card rates rise. Loan approvals take longer. Insurance costs adjust. Wage growth lags behind price increases. None of these developments alone signals crisis, but together, they shape financial stability at the personal level. This is why banking stress cannot be viewed in isolation. It is not confined to boardrooms or regulatory filings. The banking system is the transmission channel between central bank policy and daily economic life. When confidence weakens within that channel, currency stability becomes the next pressure point. And when currency stability comes into question, even quietly people begin to reassess how they store value, how they measure risk, and how they interpret the signals coming from gold and silver markets. And when currency stability comes into question, Quietly, people begin to reassess how they store value, how they measure risk, and how they interpret the signals coming from gold and silver markets. At the household level, these shifts rarely appear dramatic at first. They show up in lending standards, job postings, and borrowing costs. When banks grow cautious, small businesses are often the first to feel it. Credit lines are reduced, expansion plans are delayed, hiring slows. A restaurant postpones opening a second location. A contractor delays buying new equipment. These decisions ripple outward. Tighter credit also affects real estate. Mortgage approvals become more selective. Down payment requirements rise. Appraisals face greater scrutiny. Fewer qualified buyers mean slower price growth, or in some areas, mild declines. Real estate is deeply tied to bank balance sheets, so when banks guard liquidity, property markets adjust. Consumers feel it through higher interest rates on credit cards, auto loans, and personal loans. Even borrowers with strong credit profiles may notice stricter terms. The flow of easy money that defined the previous decade becomes more measured. None of this signals collapse. It signals restraint. To understand these patterns without reacting emotionally, it helps to use a few simple mental models. The first is the confidence loop. Banks lend when they trust that borrowers can repay and that economic conditions will remain stable. That lending supports business growth and job creation, which in turn reinforces stability. But if confidence weakens, banks lend less. Slower lending reduces growth, which can further weaken confidence. The loop works in both directions. The second model is the leverage pyramid. Modern economies are built on layers of debt. Households carry mortgages and consumer loans. Businesses carry bonds and credit facilities. Governments carry sovereign debt. When asset prices are stable or rising, this structure appears secure. But even small declines in asset values can create stress because debt levels are large relative to equity cushions. The higher the leverage, the more sensitive the system becomes to shocks. The third distinction is liquidity versus solvency. Liquidity refers to having enough cash to meet short-term obligations. Solvency refers to having assets that exceed liabilities over the long term. A banker, a household can be solvent, but illiquid if cash flow dries up temporarily. Understanding this difference prevents overreaction. Not every liquidity issue signals insolvency, but repeated liquidity stress can erode confidence quickly. Finally, there is the hard asset anchor concept. In periods of uncertainty, investors and institutions often look for assets that sit outside the credit system. Hard assets, including gold and silver, do not depend on a borrower's promise to pay. They can serve as psychological anchors when financial assets feel abstract or fragile. The goal here is not to suggest specific actions. It is to improve interpretation. When gold rises during banking stress, it may reflect declining real rates or rising currency concerns. When silver moves sharply, it may signal shifts in both industrial demand and monetary confidence. These are indicators, not instructions. By applying these mental models, viewers can observe changes without assuming worst-case outcomes. Banking systems adjust, economies cycle, confidence rises and falls. The key is recognizing where we are in that cycle. And once we understand how these pressures filter down to households, the next logical question emerges. Where does this path lead from here? And once we understand how these pressures filter down to households, the next logical question emerges. Where does this path lead from here? No one can predict the exact sequence of events, but we can outline structured possibilities based on incentives, constraints, and historical patterns. Instead of dramatic forecasts, it is more useful to think in terms of scenarios. The first scenario is stabilization. In this path, central banks manage liquidity carefully. Inflation continues to cool without a severe recession. Banks retain access to funding. Unrealized bond losses gradually shrink as securities approach maturity and deposit competition levels out. Credit remains tight but functional. Growth slows but does not contract sharply. In this environment, gold may consolidate rather than surge. It would remain supported by structural uncertainty but face less urgency. Silver would trade more in line with industrial demand, responding to manufacturing data and energy investment trends. This outcome requires coordination, patience, and a degree of luck, but it is possible. The second scenario is a controlled easing cycle. Here, economic data weakens more quickly than expected. Unemployment rises. Business investment slows. To prevent deeper contraction, central banks cut rates sooner and more aggressively than markets anticipate. Liquidity expands. Financial stress eases in the short term. However, faster easing could weaken currencies, especially if inflation remains above long-term targets. Capital may flow toward regions offering higher yields or perceived stability. In this setting, gold often benefits from falling real interest rates and currency pressure. Silver may follow, supported both by monetary demand and any rebound in industrial optimism sparked by lower rates. This path does not imply crisis. It reflects a shift in priorities, from fighting inflation to preserving growth and financial stability. The trade-off becomes visible in exchange rates and commodity prices. The third scenario is a confidence shock. This would involve a larger institution, sovereign borrower, or unexpected geopolitical event that tests the resilience of the system. It could be triggered by credit losses, funding disruptions, or policy missteps. The key feature would be speed. Confidence can erode faster than capital buffers can adjust. In that case, demand for hard assets could accelerate sharply. Central banks might intervene more forcefully. Liquidity facilities could expand again. Markets would reprice risk quickly. Gold would likely respond first, as it often does during systemic uncertainty. Silver's reaction could be more volatile, reflecting both fear and shifting industrial expectations. None of these scenarios is guaranteed. Elements of each could overlap. Stabilization in one region might coincide with stress in another. Policy decisions may evolve in response to new data. Complexity is a defining feature of this cycle. What matters most is recognizing the structural pressure points: high debt levels, sensitive banking balance sheets, shifting trade alliances, and the delicate balance between inflation control and financial stability. These forces interact continuously. As we watch banks adjust and currencies fluctuate, another layer deserves attention. Central banks themselves are accumulating gold at a pace not seen in decades. Sovereign debt burdens continue to grow. These trends raise a deeper question. If banks are quietly repositioning, what are central banks preparing for next?